So let me guess. You keep entering trades thinking you found the perfect setup only to watch the market do the exact opposite, right? You're losing money, getting frustrated, and starting to think that trading just isn't for you. Well, here's the truth that most traders fail because they don't understand the foundation of market, supply, and demand. Stick with me through this whole video because in the next few minutes, I'm gonna break it all down for you. No fluff, no gimmicks, just the real reason why the market moves the way it does. By the end of this video, you start seeing the market like the professional do and finally stop making the same costly mistakes. So enough with the chit chat, let's get into it. Today we're gonna talk about fractals, so the importance to find the confluence between higher time frames and lower time frames, and how to find the perfect entries. Like this, we're gonna lower the risk and we're gonna get a high risk-reward ratio. We're gonna talk about what is a trend and what defines it. I know probably most of you already knows, but trust me, it's good to go over things again from time to time. We're gonna talk about the two phases of the price movement, so impulse and correction, or you can even call it retracement. And in the end, we're gonna do some practice on the real chart. But before we get into this, I really want to talk about my community. So I offer free mentorship on YouTube because I believe everyone should have access to a solid trading education. But it's not just about watching videos. It's about being a part of something bigger, something that gives you a real edge. And that's why I have a community that takes things to the next level. In this community, it's not just about me teaching. It's about you connecting with others, sharing insights, and learning together. So think of it like a class, like a classroom, but way better. You've got custom support, live trading session, real-time analysis, and even news update to keep you ahead of the game. We've got different chat rooms for everything you need, from strategy breakdowns to casual conversation, and live rooms where we trade together or you can trade together to other traders, discuss real-time market moves, and help each other out. So it's the perfect way to make sure you're not just learning, but doing and improving. The truth is, trading can be lonely, but when you're inside a community like this, you'll never feel like you're going through it alone. And that's why it makes more sense to be a part of this community, rather than just relying on a mentorship. Here, you get both knowledge and the support you need to succeed. So let's grow together with ACR community. Alright, so now we can keep going with the course. So our goals is to utilize various time frames to evaluate if a zone is positioned in an optimal area, allowing us to effectively take advantage of potential opportunities. So the first thing we're gonna do is positioning. So we're gonna identify the current placement on the chart within our selected time frame. So we're just gonna look at the price, we're gonna see in what situation we are, and then we're gonna act. Trend assessment is to determine the prevailing market direction within our selected time frame, which is going to be higher time frame. So it could be the daily time frame, the 4-hour time frame, the 1-hour time frame. And then we get to the last step, zone mapping. Use to identify and place the entry on a lower time frame for better precision, lower risk, and high risk reward ratio. So the price can move in 3 different directions. An uptrend, which is defined by a series of higher highs and higher lows, signaling a strong bullish momentum. But we're gonna see about this later. The market can go sideways. It's gonna be sideways when price fluctuates between a defined range, failing to establish clear higher highs or lower lows. So this indicates a period of indecision where neither buyers or sellers have full control. And then we're gonna have downtrend that consists of lower highs and lower lows, showing strong bearish momentum. So when we're gonna trade in an uptrend, we're gonna look for demand areas. The demand refers to buying pressure in the market. So a demand zone is a price level where buyers are more active, causing the price to rise. When the market reaches this zone, this area, these key levels, it's expected that the demand for the asset will push prices up again. Traders look for these areas, and we're gonna look for these areas to enter long position, anticipating a reversal. Anticipating like this, the next impulse, which is gonna create a new higher high. We're gonna talk about the higher high, higher lows, lower high, lower lows in a bit. Now, when the market goes sideways, it means there's no clear trend, as I told you before. Prices move within a range with no strong buying or selling pressure. And so this is going to create uncertainty and increase the risk of false breakouts or random price movements. Stepping away from this situation allows you to avoid unnecessary risk and wait for clearer, more predictable trends, where of course your chances are going to be higher. Now, in a downtrend market is moving lower, with prices making lower highs and lower lows. This indicates the sellers are in control and the overall market sentiment is bearish. So in this situation, it's important to focus on supplies area. So we're gonna wait for the price to retrace in this area to enter short position, riding like this the downward momentum. So stepping in at the right time during a downtrend gives you an opportunity to profit as the market continues to fall. So I've talked right now about higher highs, higher lows, lower highs, lower lows, but let's take a step back and let's talk about what is a trend. So let's start from the definition. A trend represents the prevailing direction of the price movement. So it could be bullish, bearish, or sideways, as we watch right now. The importance of the trend is going to increase our chance of success, reducing the risk of counter trend trades. Of course, there are so many counter trend strategies that you can actually learn, but it's not our case. We're gonna follow the trend. We want to have that chance of success, reducing the risk of counter trend. The most important thing is fractality of the trend. So we're gonna switch time frame by time frame, using the higher time frame as narrative and the lower time frame as entering position. So trends repeat across different time frames by using higher time frames to understand the direction of and then switching to lower time frames for precise entries. As I told you right now, we achieve a better risk reward ratio. So doing like this, analyze the market, do top-down analysis. If you're gonna master it, we're gonna make amazing trades with amazing risk reward ratio. But how we're gonna enter in the market? Well, thanks to supply and demand. Supply and demand zones are crucial for identifying key levels where price may reverse or accelerate, especially on higher time frames. So let's talk about the uptrend movement and the downtrend movement. So the uptrend is a market movement where prices rise continuously. The trend is characterized by a series of higher highs, which are these ones, and higher lows. So an uptrend forms when there is increasing buying pressure. So we can see right here, after this all swing, this impulse phase that break this previous high, we create a new higher high. The same thing happens here. Before the impulse phase, we create a retracement to take all the internal liquidity, to then react in this area, which is going to be our demand zone, and it creates this higher low. This is the definition of an uptrend. So we're going to look right now for a downtrend definition. The same thing, just the opposite. A downtrend is a market movement where prices decline continuously. So it keeps going downwards. The trend is characterized by a series of lower highs and lower lows. A downtrend forms when there is increasing selling pressure, pushing prices to lower levels. Each new high and low is lower than the previous one, indicating that supply is overpowering demand. So as I told you right now, it's the same thing, just the opposite. We got the impulse phases, the retracement is gonna react to supply area, and then it's gonna create another impulse. And this is gonna create lower highs, lower low, lower highs, lower lows. But before going to the chart, I want to talk about the two phases of the market movement. So we have the impulsive phase. The impulsive phase is a part of the trend where the price moves strongly in the direction of the trend, either up or downwards. It is characterized by fast, significant price movements that represent the momentum of the market. So we can define if it is a downtrend or a uptrend. This phase typically attracts the most attention from traders as it shows the dominant market sentiment. So as you can see in this example, we got the impulse phase. And these impulsive phases, they're gonna create always, as you can see, new higher highs. As you can see, this is the point of origin of all this impulse, and it stopped right here, which is higher than the previous high. So this movement is gonna be a strong impulsive movement. It's gonna determine this situation, this trend, and uptrend. The same thing is happening with downtrend. We can see the impulsive phases pushing the price downwards, creating always lower lows and lower highs. And we have also the second phase, which is the retracement or the correction phase. So the retracement phase is temporary pullback or counter move against the main trend. So you can see right here we are in an uptrend, but we can see we reach a level where the price just reverse and go against the main trend. So we're making higher highs, but we can see we have this situation where the price retrace a little bit because it needs to reach our demand area in the case of an uptrend to create another impulse move and push the price. The same thing is gonna happen in the downtrend example. We create the impulse, and as you can see, we're going against the main trend for a little bit because the price needs to retrace to create a pullback to actually clean all the internal liquidity and react to the supply area to create a new impulse, to create the next impulse to go lower than the previous low. So demand area and supply area are the zones where we're gonna enter in the market. So these examples are really easy because they are theory examples, but when you go in front of the chart, it's kind of a little bit harder to understand which is an uptrend, which is a downtrend, which is a real demand, and which is a real supply. So let's go into the charts. All right, guys, in this segment, I'm gonna break down the trade that I took this morning. And so we're gonna look at the three key concepts: uptrend, downtrend, and demand supply entries. So let's walk through the whole process step by step. So first thing we're gonna look, let's go in the hard time frames. And as you can see here, we are in an uptrend. Why is it? Because we can see it break this, creating a new higher high. Then it retraces, it reacts in demand, and then it creates a new higher high. So this defines we are in an uptrend in higher time frames. So right now the impulsive move, as you can see, is being made. So right now we're gonna wait for the retracement. So something I did was defining which is my demand area. This is gonna be my demand area. Why? Because as we've seen before, the price is moving like this. Okay, so we are exactly in this situation right here where the price moves higher. So we're gonna pick this little demand and we're gonna wait for the price retrace into this area and then create a new impulsive phase, creating like this a new higher high. So higher than the previous one is the same thing. So in the moment the price enter inside this demand area, I'm gonna scale down to lower time frames. Like let's go to the 1 hour, and I can see we can refine our demand area, which could be this one. Why is that? Because we can see right here it happens that the price moves like this. Okay, the candle move like this and then creates the move. So this is going to be our demand area because it consolidates. It consolidates, so the price is going to retrace in this area to create this new impulsive move. So we go to the 15-minute. In the moment we enter inside this area from a downtrend, as you can see right here, the high is lower than the previous one. This high is lower than the previous one. This high is lower than the previous one. This high is lower than the previous one. And boom, it creates a higher high. So this high is higher than the previous one. We are inside an uptrend. So right here, we were in a downtrend. Impulse, retracement, impulse, retracement, impulse, retracement, impulse. And this is not a retracement. This is a new impulse because we create a new higher high. So in this moment right here, we are in an uptrend. So I see that the price breaks again, creating a new higher high. And so I was waiting for a retracement. And the price retrace until this area, and we can go to the 1 minute. And as you can see, in the moment the price entered to this area, you can see what's going on. The price was going lower, lower, lower until we create a higher high. This high is higher than this one. So in this moment, I always wait that the trend in the lower time frames aligns with the trend in the higher time frames. So if you remember, in a 4 hour, we were on a uptrend. Now let's go back to the 1 minute, and as you can see, we are in an uptrend. So in the moment it creates a new higher high, I was looking for a demand area. So who's gonna be my demand area? This zone right here. For always the same reason, you can see the price is going a little bit sideways and then it creates the impulse movement. So this is gonna be my demand area. Price is gonna retrace right here and create a new impulsive movement. As you can see, I enter around this area and my TP, I usually place it at 1 to 2. Today I was feeling confident, so this high, I place my TP above here. Actually, in the first place, it was up here, but I didn't close it above there because I've seen the prices in the lower time frame creating this sideways movement. So it kind of scared me because I thought, okay, the price could reverse right here, okay, and hit my stop loss. That's the reason why I closed the trade in this area, making like this for the day 1 to 5 risk reward ratio. So it's really good. And if I want to, the TP, it could be higher than that. We are in an uptrend. The retracement been made. We reacted to this demand. Right now it's going to create a new impulsive move and it's going to break this, creating a new higher high. Okay, it's not something that must happen, but it could happen. So I can even place my stop loss above here. Of course, I'm not gonna do this because, because the risk reward ratio is just too high. I'm really happy with just 1 to 5. And for the day, I did my 5%. So I'm really happy about it. All right, so that's it for today. I really hope this video was clear and helpful for you. So thanks for sticking with me. If you enjoyed this video, make sure to like, subscribe, and hit the bell so you don't miss future content. See you in the next one.